I think traders are looking at the softening economic data and the pullback in some of the inflation measures that we've had in recent months. And they think that the Fed is either done hiking now, even though Powell indicated that a couple of more hikes are coming. But again, these are 25 basis point hikes. So maybe at the most, the Fed is talking about bringing rates up to 5.25, maybe 5.5 max. But I think the markets believe that the Fed may not, in fact, get that high because they believe, A, the economy is weakening probably more than the Fed acknowledges, but also they believe that inflation is going to be coming down even faster than the Fed pretends. But the reality is inflation is not going to weaken, it's going to strengthen. But the economy is not only going to weaken, but weaken much more than the markets expect. So the markets may in fact be right that the Fed stops hiking, but not because inflation comes down, but because the economy comes down, or because employment comes down and unemployment goes up. But as of now, everybody thinks everything is great. It's a Goldilocks scenario. People are looking for a soft landing where the economy weakens just enough to bring down inflation, but not enough to bring down corporate earnings, and you're getting this rally in everything. But I think the most significant action is in the foreign exchange markets and in the gold market. The dollar tanked, the dollar index fell a full percentage point. We almost cracked the 101 handle. We closed at 101.08. This is a new low for the year. In fact, this is the lowest the dollar index has traded since April of last year. As the dollar went down, gold went up. We closed just above $1,950 an ounce. This is also a new high on the year for gold, and it's the highest price gold has traded again since April of last year. We also had a rise in bonds, a fall in bond yields. In fact, the yield on the 10-year is now back below 3.4, and the yield on the 30-year is below 3.5.5. For example, I believe the rally in gold is not only sustainable, but it will accelerate. But what we're seeing in tech stocks, for example, or cryptocurrencies is not sustainable. These are head fakes, dead cat bounces, and at some point soon, I think we're going to see a reversal as markets become very disappointed in that reality doesn't match their fantasy, especially when it comes to inflation. In fact, one of the keys to why inflation is going to be so much stronger than people think is because the dollar is going to be so much weaker than everybody thinks, because the weakness in the dollar is what's going to be the catalyst for another explosive move up in commodity prices. And it's the decline in commodity prices that is helping to keep down goods prices, which is why everybody is so convinced that we've seen the worst of inflation and it's headed lower. But as commodities start to make new highs, when the dollar makes new lows, that's going to throw cold water on that theory, and people are once again going to be afraid of higher inflation. But I think the Fed is going to be afraid to fight it because it's afraid of what that fight might do to a much weaker economy and much weaker labor market than what the Fed now expects, where the U.S. government spends money it doesn't have, and then the Fed prints the money for the government to spend. That is why we have inflation. So if inflation is causing an economic hardship, and if the government and the Fed cause inflation, then it's the government and the Federal Reserve that are responsible for that hardship. Of course, Powell will never accept responsibility for the pain that he is helping to inflict, but it's the Fed and the government that are the reason that so many Americans are suffering this hardship. Inflation is a tax. It is how we are paying for government. And so if funding government is creating a hardship for the people who are on the hook for the tab, well, it's the government that's to blame. Why does the Fed insist on 2% inflation? Because price stability means no inflation. Stable prices don't go up every year by 2%. Stable prices remain the same. That's what stability means. There's no change. Things are stable. Powell doesn't want stable prices. He wants prices to go up 2% a year, and he wants to pretend that a steady 2% annual increase constitute stability. It does not. But also, if Powell thinks that price stability as defined by 2% inflation is so important, why is his goal simply to bring inflation back to 2%? After all, we've had so many years now where inflation is way above 2%. Why wouldn't Powell be targeting a lower rate of inflation than 2%, or maybe even falling prices? Because if we want to get the average rate of inflation down to 2%, given how much inflation we had in 2021, 2022, how much we're on track to get in 2023, in order to bring the average back down to 2%, we need to have some years where it's way below 2%. In fact, it would really help if we had some years where prices fell. That would be a big relief. But for some reason, Powell is against that. He doesn't want to reverse any of the price increases. He just wants to make sure that price increases continue, just at a slower rate than the rate that they've been rising in the past. So in other words, if you think prices are too high, expect no relief from the Fed. All the Fed is going to do is increase them at a slower rate. But of course, it's not even going to accomplish that. In reality, the rate's going to increase, because in order to really make progress on inflation fighting, Powell would have to change consumer behavior. We would have to have an increase in personal savings and a decrease in consumption spending. We're not seeing that at all. Credit card debt is at an all-time high. Savings are at an all-time low. Households are spending everything they earn and then some. And then, of course, you have all this government spending. So we haven't made any real progress in fighting inflation. It only appears that way if you're focusing on the effects of inflation, which are prices, rather than inflation itself, which is the expansion of the supply of money and credit, and that continues. Even if money supply growth has slowed, credit growth has not. But you have to remember that all this better than expected news on inflation is transitory. So it wasn't the increase in inflation that was transitory. That's permanent. What is transitory is this slight decrease that we're enjoying now. And again, prices are still going up. They're just not going up as fast as they were. But all of that is temporary, because the reason that we saw a decline in the rate of increase in prices was because we got a correction in commodities, in particular oil prices. We've also got a decline in longer-term interest rates that has affected mortgage rates and probably other debt payments that are being made. That is helping to reduce somewhat the rate of increase in costs that businesses are experiencing. But all these factors are temporary. Commodity prices have already really reversed their decline. They're on the upswing. And in fact, one of the reasons that we got the big drop in commodity prices was the strength of the dollar. But the strength of the dollar completely reversed in the fourth quarter of 2022. And that weakness has continued in the first quarter of 2023. And it looks like it's going to continue, not just for the remainder of the quarter, but for the balance of the year. I still think that 2023 could end up being one of the worst years ever, and maybe the worst year ever